Hello, welcome to a special revision webinar, which is going to be focusing on two aspects of the macroeconomic debate about how we measure and how we improve living standards and human development. And hopefully you'll get something out of the next 15 or 20 minutes or so. The starting point is to think about national income. A term that's often used is gross domestic product, GDP, familiar to students hopefully. And it's important to get the definition accurate and precise. It's the total monetary value of the output of goods and services produced in the economy in a given time period. Normally a year, it could be a quarter. Typically in an exam, students are given annual data on GDP, and they can track the rise and fall of national output. There are in fact three ways to measure GDP. One is to add up total spending. We'll come to that in a minute. Aggregate demand. The other way is to add up the total demand, total incomes generated in the production of goods and services. The other way is to measure the value added in terms of output by sector. Now, in theory, all three sum to the same amount. Don't worry too much. You're not required to know the mechanics, the precise detail of this. The crucial point is that GDP is our starting point for measuring the standard of living. GDP is one measure. There is a slightly different one, which is actually now used by the IMF when they publish living standard data, and it's gross national income, or GNI. And GNI is basically GDP, but we add in the net income from investments you might make overseas, and crucially the income from remittances. There are now over 250 million people living and working in a country outside of their birth country, and that figure is set to rise. The crucial point here is that remittances, the money that flows back from, for example, migrant workers back to their country of birth, that is hugely significant now. It's almost 4 times bigger than, for example, overseas aid. And that remittance income adds to a country's GNI. Have a look at the 5 examples of countries here on the slide, and look to see how significant is their remittance income as a share of their GDP just a few years back. One that of particular interest at the moment is Nepal, the terrible earthquake, and one of the positives, if one can look for that, is that many of the Nepalese who now live and work outside Nepal are willing and able to send back money to help rebuilding and to help the humanitarian efforts. So how do we measure the standard of living? This is a classic exam question. I always tell my students to be very precise. You start with what I call the baseline measure of living standards. That baseline measure is made up of several components, but essentially it's real GDP, or real national income per head. Dollars, nearly always measured in a common currency, the US dollar. PPP adjusted. Let's go through that one more time. Real means it's inflation adjusted. Gross national income, the value of national income to people living in a country. Per capita, you divide by the population. You then convert to dollars as a common currency, and you make something called the PPP adjustment, purchasing power parity. What that means in simple terms is you try and get to a situation where essentially $100 of income in the United Kingdom would buy an equivalent amount of goods and services of, let's say, $100 in Switzerland or Germany. Of course, that's very difficult to do accurately, and that's a good evaluation point that PPP estimates are oftentimes distorted by things like taxes and subsidies and exchange rate movements. And this is our baseline measure of living standards. Now, one of the hugely topical issues at the moment in the living standards debate is what's been happening to our real incomes, our real purchasing power. I just wanted to give you a little look at this on this slide. This is a kind of very contemporary topical macro question. Have a look, for example, at the second column. This is how quickly each year earnings have been increasing. Earnings made up of the basic wage, maybe some overtime hours, perhaps if you're lucky enough some bonuses. Now look down that column. So in 2008, wages rising by 4%, nearly 5%. And if you look across to the next column, wages were rising faster than the consumer price index. So real incomes were rising by about 1.7%. But then in each of the last 5 years up to 2013, each of those years, earnings were rising less quickly than prices. Can you see that? The result, of course, is that real incomes, on average, for many people, have actually been falling. Even though the economy came out of recession in 2010, there have been several years where real living standards, if one looks at it as a basic measure, have actually been declining. I think this is an important exam issue. What are the consequences of real incomes going down? And crucially, what can be done, what policies might be most effective in lifting real incomes to sustain the recovery. GDP is our baseline measure, but of course there are questions and challenges about how accurate the data is. If we're going to use it, we might as well have some faith and some trust in it. This isn't the time for a long debate about GDP calculations, but just be aware that there are some significant difficulties. One factor which understates GDP is the shadow economy, the many people who work and earn money but who don't declare it to the tax authorities. So the shadow economy involves tax evasion, oftentimes illegal activities, and as such, there's probably a lot more income and spending in the British economy, for example, than is actually reported by the GDP data. By some estimates, GDP in the UK could be 10 to 15% higher if we made an adjustment. Now, in 2014, the Office of National Statistics did indeed introduce an estimate for the economic value, if you like, of activities such as prostitution and drug dealing. And that had an effect on the GDP figures going back. And often, just a sort of wider point, that in developing countries, in lower income countries, the sophistication and the accuracy and the coverage of the national income reporting is for good reasons, it's not particularly accurate. So you often have to treat these figures with a bit of a health warning. GDP is an inaccurate measure of the true level of national output of goods and services, but it's pretty much the best thing we've still got. However, there's a wider issue, and this is something AS students have to be familiar with, and that is whether GDP is an appropriate, a fair, a useful way of measuring how well off we are as a country. This slide just takes you through several aspects. I'll run through them fairly quickly. First one, if you read across the top row first, the first one is that one doesn't measure well-being and happiness purely by one's income per capita. There are many factors affecting our quality of life. It turns out, for example, that not just the actual income that affects your well-being, but your relative income, how much you're earning or consuming relative to other people. Your interaction in networks, your community relationships, your sense of trust and belonging and engagement are not things we can measure necessarily very easily. Perhaps things that economists should look at more carefully, but they're not included in the GDP per capita data. Oftentimes there are many things which actually add value to our lives, contribute to the wider public good, voluntary work, charitable giving, etc., looking after elderly relatives without being paid, even doing things like free economics webinars. These things lie beyond markets in a sense. They're non-market activities, and perhaps we should take them into account. Environmentalists would be concerned, on the other hand, that the GDP data really does not capture the social cost, the externalities arising from congestion and pollution and the depletion of the natural environment. So they would want to make an adjustment for that. There are many markets, as we've said, where economic activity is not recorded. We call those shadow markets. And crucially, if you look at the bottom right, the makeup of GDP is important. So a country's national income could be going up quite significantly, but how much of that is consumption versus investment? How much of that is money going into big defense projects, which probably have little effect on people's daily lives? It's important to look at the composition of GDP, not just the makeup. And an issue there is, for example, working hours. How many hours do we have to work per week to achieve a given level of output and production? So this slide, and of course you can go through this webinar at your leisure later on. We're going to upload it onto YouTube and the website. This slide takes you through some other aspects of the debate about whether GDP on its own is a representative, fair way of measuring living standards. So the national GDP data, for example, tends to ignore big regional variations in income and wealth. For sure, it doesn't tell us much about the distribution of income between those who are better off and those at the bottom end of the income scale. It doesn't really tell us much about how many years, not just how long we can live, but what are our healthy years of life expectancy. And oftentimes the national income data is a little bit slower to catch up with a world where there are many more new products available that might have greater functionality, have better quality, they might be more sustainable. How does one measure that? Equally, the bottom point on this slide is the idea of defensive spending. How much of our GDP goes on insurance against crime, theft, motor vehicle accidents, etc.? How much of our national output do we have to spend cleaning up for the effects of pollution and the dropping of waste? Defensive spending, the paradox here is that it actually adds to GDP, but I think most fair-minded people would say it doesn't add much to our welfare, certainly not to our social welfare. So GDP, I think one could say, is a useful but an insufficient guide or barometer of changes in living standards. And that's a debate that you need to be aware of for your exam. What can we do to improve living standards? Now, often this is an exam question. Examine, evaluate, assess the policies that might be effective in lifting living standards. My message to students on this one is to go back to what matters. Fundamentally, it's the level of national income per capita, the level of goods and services that we have available to consume, along with a wider range of indicators, including health and education outcomes. But what can we do to improve living standards? Fundamentally, you need a growing economy that is creating better paid jobs. So along the top here are some examples: improving human capital, for example, through expansion of the apprenticeship schemes, making vocational education higher quality and more accessible. We need to maybe reform our tax and welfare systems to get more people into work. Many people are currently campaigning for a living wage as opposed to a minimum wage to support the incomes of people in lower paid jobs. Fundamentally, living standards for me, and this is a value judgment, they are about the quality of the NHS and the accessibility of key public services. My current big topic is housing. Housing actually came up on the microeconomics paper for one of the major boards this year. But there's a huge debate about our housing stock. First of all, about the chronic undersupply of housing, but critically about how poor housing has a hugely damaging effect on living standards. One thinks specifically about educational outcomes for kids living in damp homes, health outcomes, people more susceptible to asthma and other respiratory illnesses. So you could almost build an essay around the idea that actually better, more affordable housing is fundamental. But equally, you might argue that to lift living standards, we need more businesses. We need successful startups. We need businesses to create wealth and generate the income, which will create the tax revenues from which better public services can flow. Either way, I think the essence of this slide is that you need researched, tested, targeted demand and supply side policies to work effectively together if you want to improve living standards. And living standards isn't just about GDP. And this leads us on to the second idea. This is the idea of the Human Development Index. And the HDI is a composite measure of development outcomes. So it takes gross national income per capita, dollars PPP, so that's part of it. But it also adds in an educational component, mean years of schooling, both actual and expected, and it also builds in a health component, life expectancy at birth. Each of these three measures in the original HDI, created by the great economist Amartya Sen, amongst others, each of these three measures has an equal 33% weighting. So the HDI is a composite three-way measure of basic progress in human development. Here is what looks like a horrendous table of data. It's actually just the data from 2010 and 2013 across those different indicators. So the first columns are the HDI measures, and as we go across the right, we build in each of those different component parts. Including on the right, you can see their gross national income per capita. The top of the table looks at countries or regions with very high human development, and then we work our way down. And hopefully, if you have a little time ahead of the exams, I want to have a little look at this table and see some of the progress that has been made in improving HDI outcomes. These are the countries which came top in 2013. Norway pretty much always comes top of HDI, and a cynic or a wag might say that if Norway didn't come top of the table, then we'd have to change the way the data was calculated or change the equation for HDI. But anyway, congratulations to the Norwegians, a high-income country with the best ranking for HDI. But down at the bottom, clearly, countries that will be familiar to you, where the development outcome is just a completely different league. So Niger and Congo and CAR and Sierra Leone and Chad coming right at the bottom of the league table. Now, HDI is a three-way measure of living standards, and that's been around for several years. You need to understand what it is. However, it's changing. I just want to spend a couple of minutes looking at how the HDI is altering in recent times. One of the criticisms of the HDI, if you want to add evaluation in, is that again, we're measuring what can be calculated: life expectancy, years in school, national income per capita. What some development economists would argue is that actually development is more than just income and health. It's about freedom. It's about opportunities. It's about trust, cultural identity and awareness. These things are qualitative factors and can't necessarily be measured accurately. There isn't yet, for example, a green HDI which takes into account some of the impact of development on natural capital, including, for example, deforestation. And some economists, sustainable development has to be equitable, and so we need a measure of living standards which has some inclusion of the inequality data in it. Now, for the exam, this is really key, this next couple of minutes. In 2010, just a few years ago, we saw the publication of 3 new HDI style measures. 2 of them from the United Nations, the inequality adjusted HDI and the gender inequality HDI. So let's have a look. This is the data actually for Africa. This is not the new data. This is up to 2012. But on the y-axis, progress in lifting income per capita, and on the x-axis, progress in improving health and education outcomes. And I've pinpointed Ethiopia in my presentation as a country which has made significant progress in lifting per capita incomes and also improving health and education. Angola has done even better in terms of education and health, so too has Tanzania and Burundi. Sierra Leone and Mozambique have made progress in incomes. So some sub-Saharan African countries have made important progress in reducing extreme poverty and improving their HDI score. If one takes sub-Saharan Africa as a whole, this chart is moderately reassuring and moderately supportive of the idea that the continent is improving its HDI, although not at the rate that one would necessarily have hoped for. Now let's go back to our 2 new measures. So this chart again looks a little complicated, but stay with me. The chart shows the adjustment you make for inequality. Now the red dotted line will be where the inequality HDI value is the same as the Human Development Index. So all of the countries are below it. So basically we're drawing down the countries according to how much inequality there is. Essentially, the further away from that line, the more inequality. So countries like CAR, Angola have very, very high rates of inequality, scoring nearly 0.5 Angola on the HDI, but 0.3 if you adjust for inequality. Some countries like the Czech Republic near the top, where they have less inequality, and therefore they have less of an adjustment. Now, even if we make an adjustment for inequality, the actual results are not hugely different. Norway, Australia still come top. In terms of gender inequality, I just want to pick out one country for you here. I mean, this is hugely important here. This is on the left-hand side of the diagram here. But a country like Rwanda, post-genocide, has made important, significant progress in improving female participation in politics and overall improving the economic opportunities for women. That contrasts appallingly with a country like Yemen, where life, presumably, Yemen is extremely unequal, often very brutish, and nearly always rather short. Countries, again, Norway comes pretty well up on this list, but again, we're making here an adjustment for gender inequality. I guess the issue here is that we're taking the HDI data and we're saying it's useful, it's important, but we want to dig a little deeper and look at some other issues to get a more holistic view of development. Finally, inequality. This is something which is hugely important. We've mentioned it in previous webinars. It's a major issue when you come to talk about living standards. Don't forget that GDP per capita is a measure of average income, per capita income. It doesn't even measure median incomes. And many economists would argue that actually to get a better picture of where a country is in terms of the distribution of the benefits of economic activity, you need to have a measure of inequality to guide you in terms of assessing it. Now, these are the countries, just finally, who have got the highest income inequality in the world. The Gini coefficient on this scale can reach a maximum of 100, so it's nearly always expressed as up to a maximum of 1. But of the major countries, South Africa has the highest income inequality in the world. Namibia is even higher, and the Seychelles came top in 2012. A country like Brazil is amongst the 20th most unequal countries in the world. So if one gets a question about rising GDP per capita in countries such as Brazil or Zambia or South Africa, keep in mind in the exam that these countries have very high rates of income inequality, and that should be part of our discussion. So this has